Hi there, my name is Tim and welcome to my channel. With hundreds or even thousands of ETFs and funds out there to choose from, where do you, as a beginner investor, find something that's suitable for you? This video will go through some simple steps to consider which will hopefully make it easier for you to find a fund that works for you. Before we start, I need to tell you that this is a financial education video and should not be construed as financial advice. Make sure that you fact check anything that anyone tells you on YouTube, including what I tell you on this channel. Do your research to ensure that your investment choice is correct for you. And if you are in any doubt, seek advice from an independent financial advisor. Where do we then start on our journey of choosing a fund? Firstly, you need to consider whether you're a passive or active investor. As a less experienced investor, you probably want to choose the passive route and select a passive fund or ETF for a passive portfolio. An active fund would involve regular maintenance and would probably cost more than a passive fund, as active investing would involve a more hands-on approach in relation to your investment of choice. There are no guarantees that this additional risk and additional costs would reap you greater rewards than to invest in a passive fund. As a beginner, choosing a passive fund would mean less work for you to do, would cost less, and would generally give you the returns of the index that the fund tracks. Arguably, you could just set up your direct debit in these circumstances, pay in money regularly, and completely forget about it. Now we've talked about the passive side of things, let's talk about diversity. In choosing your fund, you can reduce the overall investing risk by diversifying. You can enhance this diversity by spreading it across more companies, in more countries, in different sectors. Choosing a global fund or ETF might be a good choice for you as a beginner investor. And then within that global fund, you might want to choose what type of company you want to track, i.e. large cap companies or all cap companies, where the fund consists of companies of all sizes. So now that you've considered the parameters for the diverse fund that you're going to choose, you now need to think about your objectives. In reality, talking about objectives is a complex matter that I won't be able to do justice within this video. So for the purposes of this video, I'm going to assume that your objectives are that you wish to accumulate a pot of money for your retirement at the age chosen by you. If you are unsure about what your objectives are, what you're trying to do from investing, then maybe seeking the advice of an independent financial advisor would be the way to go for you. We now need to look at your tolerance for risk in choosing the investment that you choose to reach your objectives. You've heard the phrase risk versus rewards. Well, this means generally that the more risk you take, then potentially the better rewards you will get. But adversely, your capital is at risk from you investing it, and you may end up getting less back than you put in. Keeping things simple, the younger you are on your investment journey, the further away you are from that retirement pot that you're going to claim, and the less chances you should have of drawing on that money at an early stage. Obviously, the risk of drawing money out is that you could be drawing money when the markets are low, and in those circumstances you're likely to get less money back. So if you can keep your money in for the longer haul, you reduce the risk of getting less back than you've invested. So as a younger investor, where the plan is you're not going to touch that money for many years, then maybe the strategy you adopt would be a more risky strategy. And when I say a riskier strategy, I mean talking about investing in equities such as stocks and shares. Be minded that the more risk you take in investing, the more volatility you are going to have in your portfolio. No matter what age you are, your tolerance for risk to a degree will hinge on how you react when you see your shares and your investments going down. Will you be able to fight the urge to not realise your investments when the stock market is going down, knowing that over a period of time, the stock market will rebound and get higher than the position you're currently in. And as you get older, the longer you invest, the volatility in your portfolio should reduce. So as a younger person, you might be open to investing in the more volatile assets such as stocks and shares, taking the roller coaster route. And you would do this to maximise the growth that you would get in your investments and to build a big enough pot for retirement. Time is your friend here as a young person. So equity or growth stocks might be your investment of choice. As an older person who is more likely to draw upon their investments in the shorter term, or for the more cautious investor, You might opt for the blended fund, which will hopefully reduce volatility in your portfolio and take diversity to another level. Blended funds are often different funds of different asset classes bundled together, such as equities like stocks and shares that will give you the growth within your portfolio, and bonds, which act as a more defensive investment. The argument is that bonds are less volatile, so that in periods where the stock market is going down at a rapid rate and your equities are following the stock market, bonds won't go down at the same rate or might even rise. Negative correlation is when one asset rises as another falls. This makes your fund even more diverse. It makes your roller coaster ride less gut churning, ironing out the highs and the lows. With the reduction in risk of market lows from using bonds comes the reduction in your potential performance going forward as well. So you need to consider whether the reward that you will get from this fund is sufficient for your objectives. We will talk about past performance of funds and ETFs a little bit later in this video. There are many blended funds available. Vanguard do their life strategy range, and AJ Bell also have their own version of this. There are many others also. You can get it 80% shares, 20% bonds, 60% shares, 40% bonds, or more bonds and less shares. Both Vanguard and AJ Bell help you to choose the right blended fund for you by asking you a set of questions which helps determine your tolerance for risk. It's not perfect, but at least it gives you a starter. Finally, before we move on from blended funds, it's worth considering how long you intend to invest for. When we are looking at stock shares, then generally the minimum period of investing should be between 3 and 5 years. If your investment horizon is less than that, then maybe you should consider a different form of investing, such as savings. So now you've chosen a fund in line with your objectives and your risks, you now need to consider whether it's accumulating or distributing. Remember, for the purposes of this video, we're assuming that your objective is the retirement pot at an age chosen by you. Therefore, when faced with the choices that some funds offer, accumulating may be the best choice. Accumulating means that the dividends that the companies pay are automatically invested back into the fund. You don't have to do that yourself. If you chose a distributing fund, then the dividends will be paid to you and you would have to pay them back in yourself. Can you ensure that you're going to pay those dividends in and won't just leave it sitting there as cash in your account? There is also research out there that accumulation funds do tend to grow bigger than distribution funds over time. So moving on from your choice of distribution and accumulation, we now need to look at the past performance of the fund. This information should be available when you click on the funds page or on the investment platform where the fund is held. Check back 5 years as a minimum and for consistency, and then compare this performance with the other funds that you've shortlisted over the same period. And remember that past performance is no guarantee that the fund will perform in the same way in the future. But at least it gives you a guide as to how the fund has performed previously and recently. And the next thing you need to drill down into is how much the fund is going to cost you. With your narrowed down list of funds, you can now start comparing prices between them. Funds have ongoing charge figures. These illustrate the total cost of administering the fund, and these are displayed on the fund pages, so it is easy to compare prices. Aim to get the lowest fees possible. Every pound or dollar spent on fees will be £1 or dollar less to add to your pot and to help you compound your wealth. So the next step is to look at currency. I would certainly not disregard a fund that you've found with all the other positive factors just because it's not in your currency of choice, or perhaps your home currency. Different funds and ETFs are denominated in different currencies, and purchasing your fund in a particular currency could somewhat impact your fund depending on how the currency the fund is purchased in compares with your home fund, for instance. And that could include working in your favour and having a positive effect on your fund. As a beginner investor, I wouldn't get too involved in this. Maybe as a comfort blanket, try to choose a fund which is denominated in your local currency, your home currency. Or choose a fund that has been hedged to your home currency. Currency hedging means that currency fluctuations have been smoothed out to have less impact on your fund. Okay, so moving on, the next step is now to choose where to purchase your fund of choice. You will often have more than one option, as to where you purchase your fund. Investment platforms are online stockbrokers and are probably the easiest choice for a beginner investor to get their fund. There are many reputable providers out there. You may find that ETFs are available with more providers, whereas funds are a little more exclusive. But if there is an option to purchase your ETF or fund with more than one provider, then it will be prudent to compare the costs of those providers. Your provider of choice will also have fees in addition to the fund of choice. On investment platforms, generally, the main charge is the management or the holding fee. This is the charge for actually holding your investment on the platform. Some platforms charge you a percentage of the total amount of investment you have on their platform. Others charge you a monthly rate, and this is regardless of the investment size. You'll have to do the math as to how much you're investing and how the fees impact on your investment. Maybe compare the percentage version against the monthly fee version and see how much it costs with the same investment amount. Platforms often have other charges depending on the provider. Some of the most common would be trading fees, such as buying, selling, transferring, entry and exit. Consider what you intend to do with the fund going forward and then see if that fits in with your provider of choice. Hopefully, you have listened to what we've discussed during this video and you will be selecting a diverse, passive index fund that you're just going to let grow over time and invest into regularly. This should keep your transaction fees to a minimum. You also now need to consider what type of account that fund will be held in. If you can, try to ensure that your investments are held in a tax efficient fund such as a SIPP, which is a personal pension, or an ISA, which is a tax-free savings account. Both of these accounts have good tax efficient benefits. SIPP accounts, that personal pension or self-invested pension pots, are a little more exclusive than ISAs and may be available on less providers. So choosing a personal pension could narrow down your choices of provider. To help you get more information on your fund, you can go to the funds page, or if the fund is held on an investment platform, there will often be information on there also. Contained in each fund is a key investor information document, which you might see under the abbreviation of KIID. This has to be published on the fund's front page or as an attachment to the fund for it to be sold to retail investors like you and me. The KIID document is very useful as it provides a whole lot of information about the fund in a generally easily readable format. It provides such information as the fund's objective, i.e. what index it tracks, the size of companies in the index and whether it does this passively or actively. It provides information on the type of investments, whether they be shares, bonds or other assets. It gives you the ongoing charge figure, the OCF. It provides the past performance of the fund. It tells you what currency the fund is denominated in and whether the fund is accumulation or distributing. It also provides the risk level of the funds, and risk is generally on a scale of 1 to 7, 7 being the riskiest. And then it gives you some structural details about who manages the fund, the depository and other stuff. The KIID document provides a lot of answers to the factors that we discussed today. Research sites such as Picker Funds, Just ETF and Morningstar have filters that you can use to whittle down your choice of funds to a short list based on your preferences. Well, I do hope that this video has been of use to you, and if you're yet to invest, that it'll help you take the first steps on your investment journey. And if there are any questions unanswered, then please comment below and feel free to ask. Also, please comment if there's any other content that you want me to cover. If you like what you've seen today, then please consider clicking the like button. This really helps me grow as a channel and it is much appreciated. If you would be interested in seeing more similar financial content, then please consider hitting the subscribe button and to turn on notifications so you're aware of when I've posted new content. I really appreciate your time and thanks for watching.